Joining us now for more on the Fed and the latest market moves, Amy Kong, Corient partner. Amy, actually, I just want to start right there. You heard Julie and I talking. You look at the indexes showing green today, but small caps, Amy, that is a subject of a lot of conversation. They are working again. What does it tell you, Amy, just about the broader market here?
Yeah, Josh, it's a great question, and I appreciate that. I think we're basically seeing another episode where investors are more risk on, hopeful that the Fed is going to cut this year. And in essence, we've seen that episode play out a few times, starting from the beginning of the second quarter, where investors have been really just wavering back and forth in terms of what the Fed is likely to do and how soon they'll do it. Whether or not this is a sustainable rally, that's something that I would be continuing to watch. Essentially, you've got small caps and some of the cyclicals performing better in recent days. But I think the Fed continues to be super data dependent. And while the Fed is likely not going to cut in July, we're talking about September, there's still 2 more inflation data points to come between now and then. And if any of those data points start to either plateau or reverse to any degree, I think the Fed starts to hesitate a little bit again. So whether, again, this is a sustainable rally, I would say just be mindful, watch it carefully, and not necessarily conclude that this is more sustainable than not.
So this is a really interesting point, because the market now seems to be, okay, September it is. And your message is, let's not get ahead of ourselves, right? That it's not a certainty, even though the market is pricing it in that way.
I think that's a fair statement, Julie. And all this year we've seen that happen, not so much in the first quarter, but in the second quarter. The market's focus has, again, just been back and forth, whether it's on monetary policy. It was offset by a decent earnings season, and now as we're getting closer to whatever the Fed said more recently about not having to wait for the data points to hit 2%, maybe they'll cut a little bit sooner than that. You've got also a lot of other central banks already cutting rates around the globe. There's pressure on the Fed, and so again, that momentum is shifting more to monetary policy. I would also add too, as we're heading closer and closer to November, there's a third dynamic, which is the political season, and Americans, investors, obviously this is a very sensitive issue for many. They're likely to be more volatility, from my perspective, in terms of where the market's direction will likely go over the next couple of months.
It's interesting, Amy, though, because we've had strategists come on who almost suggest they think September's a lock at this point. So if the market didn't get that cut in September, how do you think the market reacts?
It really depends on what the Fed messaging is. So when you saw the Fed readjust their summary of expectations and the projections going into next year, while they did reduce the number of rate cuts for 2024, what they did was they added that rate cut, if you would, or the number of rate cuts, while they reduced it this year, they added it onto 2025. And so from my perspective, the market kind of took that as a neutralized or a non-event, because it's not necessarily saying they're not going to cut. It's just push down the way a little bit. And from that standpoint, the market didn't see too much of that. So going back to your question, when it comes to September, if the messaging is, hey, the data is still kind of fluctuating back and forth, we're on a path to where we think the goal would be, I think the markets would be okay with that to a degree. But I think the messaging, if it starts to turn the other way, where they're saying, oh, hold off, the data is becoming a lot hotter than what we're thinking, maybe we won't cut, or any of that type of commentary, the markets, in my personal opinion, could, again, turn the other way around.
I mean, and it's been so long since we've had that kind of a turn, at least on a single day, right? As you pointed out in your notes to us, it's been a year since we've seen a drop of 2% in a single session, which is unusual to see that span of time.
Oh, yeah.
So the Fed is, and the timing of the rate cut, one of the potential triggers. What are the other sort of danger signs or risks that you're looking for in the market right now?
I appreciate that question, Julie, and it's spot on when we think about valuations for the market. To your comment, the S&P has not retreated more than 2% in now over a year. I'm thinking it could be as much as 18 months. I haven't counted, but in general, it's been a very long streak. And when you think about the streak being this long, it's natural to think that perhaps a breather is likely to happen, or some kind of pullback to an extent, and we haven't gotten there yet. So now that we're entering this next earnings season and we're starting to see some of the bellwethers report, while some of those data points have been reasonable, we're going to hit tech, which is the heart of earnings season in the next couple of weeks, and then retail towards the back end. That could be one of the factors that decides, is the market going to pull back a little bit? You've got the S&P now trading at 20 times forward earnings. It's at a 10-year high. Not to say that we're looking for any kind of major pullback, but any kind of soft pullback just to reset expectations, in my opinion, is normal. Is
and would
actually
you
healthy.
add there if that happens?
Depending on where the pullbacks are, we're very mindful. I'm very mindful of concentration risk. So to the extent that some of the tech companies, which have done very well and have reported decent, especially the ones that are exposed to AI, exceptional results, they start to pull back. You want to just be careful, just knowing that they have just done so well. They make up, as a group of 10, make up close to a third of the S&P, maybe not so much there, but looking for those other 490 companies that have not broken out yet. Maybe there's opportunity there. We're starting to see that this month. It's nice to see the equal weighted S&P index actually outperform for a long time, for once in a long time. That's great. We really need to see that happen more and a more sustainable in order to really call this rally a sustainable rally.
Amy, thanks so much for coming in. Appreciate it.